Hello everyone, welcome to this series on option basics. Till now we've covered the basics of options. We've talked about two strategies, that is the debit spread and the credit spread. This is the fourth lecture and we are going to talk about the ratio spreads. So in my opinion, this is one of the most important strategies for a options trader simply because it can be used in many diverse cases, right? So I personally use it a lot and so it'll be interesting. So let's get started. So firstly, things that we want to understand is when do we create a ratio spread, right? So we create a ratio spread whenever we have a neutral to slight directional view, right? If we have a very strong directional view, then probably we would avoid creating ratios. But if our view is that there will be small amount of movement or the markets will remain there, that is where we create the ratio spread, right? And how is this created? So we buy a ATM or a OTM option and we sell two double the quantity, the OTM options. For example, let's say if I'm buying 40,000 call, right, and this I'm doing one lot, and I could be selling two lots of 40,300 call, right? So this will be called a ratio. Now, the ratio here is 1:2. So this we can also say this is a 1:2 ratio. If I were selling, let's say, three times what I've sold, what I've bought basically. So this is a buy and this is a sell. So if I'm selling three times what I've bought, then I can say that this is a 1:3 ratio spread. So similarly, you can go on and make 1:2, 1:3, 1:4, right? Generally, the standard thing is to go with 1:2. Okay. So the other variation that could also be there is, let's say I buy one lot of 40,000 call and I sell one lot of 40,300 call and again I sell one lot of 40,500 call, right? So this is also a ratio. This is also a 1:2 ratio. But here what we have done is we have sold two different strikes. We did not want to concentrate here at 40,300. So we went ahead and sold a higher strike. So these are the things, these are the technicalities that you'll, as you start using ratio spreads, you'll understand. But I just wanted to kind of tell you that how you can build or create a ratio spread in different ways, right? And the word front that is used here is because so here what we're doing is we're in case of call, so we're buying something and we're selling something higher. So that is called a front ratio spread. If we do, let's say we buy 40,000 call and we sell 39,800 call, right? So that would be called a back spread. I'm not talking about back spread in this session. We'll probably take that separately. So I just wanted to explain why we're using the word front here. All right. Okay, so the other important point to note is that the overall position generally should result in a net credit. So, which means that whatever we are buying is getting debited, and whatever strikes we're selling, the premium is credited. So, the sum of these things should be positive. So that we get a net credit. So, for example, if we bought, let's say, we're doing a ratio of 40,000 call, right? We bought one lot at let's say 500, and we sold two lots of 40,300 call at 300. So which means this we are paying from our pocket because we are buying. So this is minus 500 and this we are getting since we are selling. So we're getting this premium into our pocket. So this is 2 into 300, which is equal to 600. So if you add these two, net comes out to plus 100. So this is what net credit means, that after building the position, we are getting something positive, right? If this were, let's say 250, so if let's say this were 250, then what would be the net credit? It would be zero. So there will be no credit, no debit. And if this were 200, then net debit would be minus 100, correct? So generally what I've seen is it's okay to even have a small credit or zero credit, but generally we should not have a big debit while creating a ratio spread. Okay, so keep these points in mind. When you apply this practically, all these things will come in handy. So now let's look at how do we create a put ratio spread. So let's say the market is trading around 40,700 and our view is that the market is going to go down, but since it's already moved on, it's not going to go down a lot. So if our view would have been that, okay, the market seems to be having a very good momentum, there could be a big fall, I would have gone with a debit spread, right? But here the view is that it could go down, but it could bounce back as well, or the down movement is not too much. So here we're going to create a ratio spread. So the first thing is we'll buy a ATM put, which is 40,700 put, which is trading at 510. Okay, and then we are going to sell two puts of 40,400. So this is trading at 393. All right. So this will constitute a 1:2 ratio spread. Now let's look at a few calculations. And so the spread is clear. So this is a 300-point spread, and the net credit that we are receiving here is so this is as we did the calculation in the last slide. The same formula is used here. So this is the net debit. This is the debit that we are incurring due to buying of the ATM leg, and this is the credit that we get by selling 2 OTM legs. So net credit is 276. The max profit formula is spread plus net credit into the lot size. So the max profit comes out to, this is 576 points, and we multiply it by the lot size. So max profit comes out to 14,400. Okay. And where does the max profit happen? Max profit is happening at this stage. If the expiry happens at 40,400, because think about it, what will happen at this point? The ATM leg would be trading around 300, and both of these will go to zero. Since we are expiring here, both of the puts 40,400 will go to zero. So we'll get the max profit in this, and this will incur some loss, but that's fine. That will get compensated. If we start going below this point, right? So for every point that we get on the ATM, we lose 2 points on these OTMs because the lot size is double, right? So this becomes the max profitable point. And what is going to be the max profit as we calculated? It's going to be 14,400. Now let's talk about the break even, right? What is the break even point? So break even here is going to be when this starts going down. So for every 1 point that we make here, we lose 2 points here, and there'll come a point which is 39,824, where all the profits that we incur from this will get compensated by this loss. So the formula for this is leg 2 minus max profit. Leg 2 is 4,400 minus max profit is 576. So this is going to be a break even point. All right. And max loss in this strategy is unlimited. So if the market continues to go down beyond this point, we start incurring losses. So which means that beyond the point, we have to activate different types of adjustments to manage the ratio spreads. Okay. All right. So next, let's talk about what is the payoff chart going to look like for this. Okay. X-axis is your spot price, and y-axis is your profit, and we are plotting this basis the spot price at the expiry. Okay. So the spread is 300 points, and max profit we know is 14,400, which is this point. And if we expire above 40,700, right, which is above this point, this is the point that we did not discuss. So what will happen? Everything will become zero, right? Because if you are expiring above these levels, this put becomes zero, this put also becomes zero. So whatever was the net credit will be our profit. Okay. So this here will be, our profit will be 276, which is the net credit multiplied by 25. This will be our profit for this line. Okay. So and the break even point here is, as we've discussed, it's going to be 39,824. Okay. So this is the plot. We get a very big range as you can see. So we're creating this at around 40,700, and we remain profitable for a good 2%, right, till 39,824. So you get a lot of time, markets to kind of settle down, move in your favor. You don't need to adjust immediately. Once, but we are closer to the break-even point, that is when we should think about adjusting. We can cut down so what are the possible adjustments? Let's quickly go through them. That's slightly an advanced topic, but that's important to know as well. So one could be to cut off one OTM put. So in this case, since we are carrying 2 puts on the short side, so what we can do is we can cut off one of the OTM puts, which means now we'll end up having 1 buy and 1 sell, right? Initially we had 1:2, so we had 1 by 2 sells. So this ratio gets converted into a debit spread. Now it does not matter how far the markets go down, our loss will be capped. It will be limited, right? The second adjustment could be to buy a further OTM put. Right, so we want to contain our losses. So once it is gotten here, that is 39,800, 39,900 levels. What I would want to do is buy something here. Maybe buy a let's say 39,600 put or 39,700 put, depending on where we are standing, how many days to expiries are there, what is the premium of these tags. So it depends on a lot of factors, right? But these are the 2 things that you should keep in mind in order to do the adjustment, right? As you do more and more of these trades, you'll kind of also get an understanding कि कैसे इसको, how do we adjust this, right? So yeah, and so one thing that I wanted to also discuss is how do we convert a debit spread into a ratio spread. So this is something that we do a lot with all the people. I mean, in our courses as well. Once we have a view, we go with debit spread, and if it does not work out, we convert it into a ratio spread. So how is that done? So I'll give you an example. Let's say we are very bullish in the markets, and we feel that it's going to give a good bullish move, right? So let's say I buy 43,000 call, uh, let's say 10 lots at 100. Okay, and so since this is a debit spread, so this is the buy leg, and I sell 43,200 call. Again, the lots would be same since this is a debit spread at, let's say, 75. Okay, so what is the net debit here? Net debit is, so we are buying this minus 100 and we're selling this, so plus 75. This comes out to minus 25. So we are having a debit of 25 points. Okay. Now, for some reason, the markets do not move in our favor and our view goes wrong. So one option is to keep holding this debit spread and incur a loss of 25 points, right? So we are having 10 lots, so 250 is the quantity multiplied by 25. So around 6250 ka loss we have to incur. Now what we generally do is we convert this. If the view is not going in our favor, then obviously the buy thing will go down. So this price will start to go down from 100, it will come down to 90, 80, 70, 60 like that. So what we say is that we'll sell half quantity of 43,000 call if premium halves, right? So if 43,000 call comes down to 100, what we'll do is we'll sell 5 lots of 43,000 call. So what we are left with is, now our net position would be, will be plus 5 lots into 43,000 call, and we do not touch this, so minus 10 lots into 43,200 call. Okay. So now what we've done is, initially we started with a debit that has been converted into a ratio now, because if you look at this is 1:2. So this becomes a ratio. And if both of these, the view has gone wrong, both of these will probably end up at 0. So what will be the PNL in this case? Let's do a quick calculation. So basically 43,000 call, 5 lots will incur a loss of 100 points, and in another 5 lots we'll incur a loss of 50 points because we exited half at 50, correct? So this will come out to 500 plus 250, so this is minus 750, correct? So so 5 lots is there, so okay, so actually this should be 125. If we are considering 25 is the quantity in one lot, so this will be 25, sorry, 125, right? So this will basically be minus 125 into 150, okay? And what will be the profit that I'll make from 43,200 call? That's straightforward. So we have 10 lots, so 250, which is 10 into 25 multiplied by 75, right? This will be our profit. So net basically, how much will this be? This will be minus, yeah. Just a second, guys. I'll quickly do this calculation. So this is equal to minus 18,750, and this is equal to 250 into 75. So 18,750 again, right? So this we end up with no loss, no profit. Obviously, there will be a cost of brokerage and all, but overall we end up with no loss in this case, right? So this is how we kind of convert between the ratio, between debit and ratio. This is one of the things that I discussed with the people in the course as well, and definitely comes in handy when you are managing a directional view, right? Hope you like the video. Please share it with your friends who are interested in learning about options, and I'll see you in the next one. Thank you.